I think we've seen in previous crises, and I'm not saying there is going to be a crisis. This doesn't have a crisis feel to me about it, by the way, but you know, crises are always something that we didn't know about until they happen. And honestly, I don't know the extent of the leveraged loan market and how much is out there that we don't really know about, that isn't investment grade, that isn't, you know, is somehow hidden through these other borrowing channels. Maybe it's there, but it's not like screamingly obvious the way, I mean, the mortgage market in 2007 was crazy. You know, people were giving out toasters and lining up at empty Miami Beach buildings.
And there's some of that happening with corporate debt, and this is where Druckenmiller and others have said, look, if the reason why the Fed should have tightened sooner is because companies have piled on, and this is the stuff you can see. They've just taken out they've put on so much debt. I think the number is $7 trillion or something like that since the crisis. So is that the new problem? We haven't really seen a problem like that in a while.
Well, honestly, I don't think it is necessarily. I mean, you know, people are, starting with the president, have been bashing the Fed lately, criticizing them for raising rates. But my question is, what do these critics know that the Fed doesn't know? What is their superior information out there? Does the Fed not know where the debt? I mean, we do know from past history that the Fed is not necessarily all-knowing. But presumably, they are getting a ton of data in there, a lot of which we don't see. I assume they have data that also not just reflects what's happening now in the economy, but which is, you know, are leading indicators about what's going to be coming up. And they went ahead and raised rates. And I don't think they did that just to spite the president or just to show that they're independent. They said over and over again, we're data-driven, we're following the data, this is what the data suggests. And I don't feel I'm in a position to say, oh, I know more than they do, so this is a mistake.
So what's happened in December then in equity markets? The market is wrong to think that there could be something worse around the corner, or is that is what it's pricing in at the moment?
Well, I don't know that they're pricing in disaster. I mean, the stock market was very richly valued by September. I mean, the average market PE was somewhere up in the mid-20s compared to, you know, an overall historical average of around 15. I mean, it was extremely richly valued. It was exceptionally optimistic about what was coming forward. At the same time, I think part of that was driven by the very, very low interest rates. There weren't any good alternatives to stock markets. And I think there has been a sort of recognition that A, valuations were really high, and B, you're starting to see, you know, I've been hearing more people boasting about how they're getting 2 or 3% out of their money market fund.
Yeah, cash has a yield. It's a super important distinction that that hasn't been true for years.
I mean, you know, just from holiday gatherings, and people are coming up and were like crowing to me about the big CD they just bought. I mean, I have not heard that in at least 10 years, and maybe longer.
Because it hasn't been true in 10 years.
Well, that's true.
But you think you would buy? So Facebook is now trading less than 18 times forward earnings. Google is crazy.
AT&T has a yield of 7.5%. To Andrew's point.
But even for the high flyers, would you be buying these companies here,
I mean,
Jim?
It's definitely some of them. I think the big tech stocks, which, you know, really got way out there, and there was I won't call it a bubble, but there was a kind of like what's something.
We have an acronym for it. That's how you know there was a mania. It's FANG.
There was definitely a FANG, the FANG mania, which I think got out of line. They're now down as a group, well over 20%. And I think some of their, like a Facebook valuation like that, that's starting to look really good. I think most of them are advertising-driven stocks, and the consumer looks very healthy, very confident. The employment numbers are great. I think the advertising market's going to be very solid going forward.
And if they get regulated, it's probably just going to shore up their business, frankly.
Yeah, and they're grabbing more share from traditional advertisers. I think some of them are starting to look attractive. I'm a little less excited about Apple, which is less of an advertising play, but they are doing some interesting diversification things. I mean, I think the story at Apple is they've got to diversify away from the device.
Do you see any sign that the watch or whatever else you think is up their sleeve, pardon the pun, a watch is up your sleeve, is on the horizon?
Well, you never know. I mean, they're very, very. How secretive are they about what they've got coming?
They're
out?
driving around autonomous cars, by the way, in California. There was an accident a couple months ago that was actually reported that might give you some sense of what kind of thing they may have coming up.
I think it's obvious they're trying to focus on health, and they're
Right.
trying to focus on this heart stuff, Jim. And
Right.
I frankly, I think all the regulation is going to come from the mental health side with regard to these iPhones and what they're doing to society. They've been making the iPhone to cigarette comparison for 20 years already, basically, or 15. And so it's probably their way of saying, look, we're trying to help promote health.
Right, which, I mean, look, it's a very, very big market. It's a big addressable market,
Right.
and I don't blame them for focusing on that. The watch, I would say so far the watch hasn't taken off.
But
really.
the question is, in a year or two from now, whether anybody over a certain age is going to have the watch simply to do the EKG and because it has a fall alert on it, right? So if you fall, it'll automatically alert. That unto itself could actually be worth easily $400. I mean, when you think about how much an EKG used to cost.
But when I was in college,
and all
guys
the
had
other things.
posters of Steve Jobs in their dorm room.
No, I
I don't
understand.
think that kind of company.
I understand, but if everybody buys one of these watches and they're the only ones doing it, and I mean, the question is where the fast follower will be to actually, compete with them on that. That actually could be a huge market.
I totally agree.
They take away from the cool factor, which is a whole other problem.
I think investors often tend to look at these companies as static. They're not getting a big premium for potential innovation, and yet they have a very good historical track record. They have the resources to try and fail and try again, which I think is important. And they have the brains and the talent. I mean, look at how they are attracting, young, smart people. It's not just Silicon Valley and Seattle. They're moving all over the rest of the country. They're putting up new centers. They're getting a lot of brain power, and their track record of innovation is very impressive.